before she was born, we knew that we would have to kind of ensure she's financially taken care of. I figured out that there were children who invested as early as 6 days old.
Money becomes the reason for confusions between spouses, confusion between children and parents.
We'll eat first and then diet later. We pack a healthy tiffin first and then eat guilt-free. It's as simple as that.
Money which we have in our portfolio is primarily for our retirement. The money which she has, it's practically for her education.
If there's one thing that everybody seems to have an opinion on, it is how to bring up your child. Whether it's your own parents, or whether it's your neighbors or your friends. They've all got an opinion about what you should and should not be doing, whether it is having certain manners enforced, or which school you should be putting your child in, or what their time should be used for, what sport they should be playing. But the fact is, I've spoken to a number of parents and they all agree that most of them are just winging it. They're doing it for the first time and they're hoping and praying that they're doing it right. So when it comes to planning for the finances that you need for your child, a lot of people are doing it for the first time and don't know whether they're doing it right. So today I'd like to talk with two people who advise other people on finances for a living and happen to be married to each other. And I wonder whether they approach the planning for their daughter in a more sorted manner. I'm joined by Megha Malpani, who is partner at Zvest Financial Services, and Harsh Kumar, managing partner and co-founder of Zvest Financial Services. Of course, you're partners at work and partners at home as well. Thank you so much for taking the time. Anyone can take this. Were you planners before you got married?
Not really.
Okay, so you took it up later. What's the story?
No, we were into the field of wealth management earlier, but I think post we got married, when we started Zvest, I think the whole approach towards very structured financial planning, which kind of reduces confusion, and philosophy which helps you build a structure, got stronger. I think we have learned from other people with the way we manage our clients' money on how to also start, planning for ourselves. So I think planning really started 5 to 6 years ago, before our daughter was born.
Oh, 5 to 6 years before. Wow. So when did you get married?
So I got married in 2015. I hope the date is not wrong or the year is not wrong. That's a tricky question to start with.
No, you better remember those dates. So certainly, okay. So you got married in 2015, and you're saying that you planned for quite a while before your daughter was born, right? What was the thinking about?
So, Alex, our daughter was born in 21. And I think, before she was born, we knew that we would have to kind of ensure she's financially taken care of before she was 3 years old. We didn't want to go through a monthly SIP way for her. We wanted to kind of keep a target that before she is 3, we have sorted her finances out. So we did a reverse engineering. We figured out how much we would have to invest per year. And we just got about doing that. We started her on her investments when she was 2 months old. And believe me, I thought, she would be the youngest investor in a lot of mutual funds. But this Children's Day, when I was doing some research, I figured out that there were children who invested as early as 6 days old.
6 days?
Yeah.
Wow.
And the beauty is that we checked 2 cases where one child was 6 days and another one was 11 days. And both of them were from tier 2 towns in India. So none of those 2 was from Bombay, Bangalore, Delhi or Calcutta.
I'll talk to you about what you invest on her behalf, because this will give people a sense of what your thinking has been as well. But when you say that you reverse engineered,
right,
obviously at that point, you've already been aware that you are going to have a child.
Right.
A lot of people don't even know that. So, Harsh, how do you start planning for something you don't know for certain will happen?
Right. So I'll just take a step back. Now, it's not just about planning for your child, which sets the temperament for investing. So when we got married, we were also not sure when will we have a child and all those things. But we started sorting out our finances because, believe me or not, in India, we don't talk about money within families, within spouses. But we have seen a lot of studies, we have seen a lot of cases where money becomes the reason for confusions between spouses, confusion between children and parents, confusion between uncles and parents, and it's a very complicated world if not managed properly. But if it is managed properly, then it's very simple also. Then we decided that let's have a rule book at family level on what we will do with money, what we will not do with money. And if I have time, I'll explain.
No, please do, because, and also I'm curious, so you're partners in a business.
Right.
And I have asked this to other business owners in the past on this very program. Do you pay yourselves salaries?
Yes, we do.
Yes.
So therefore, I'm curious about how two financial planners or financial advisors do the saving that they do on an ongoing basis. What is the kind of methodology that you follow? Do you each invest separately?
Yes, we do invest separately in our individual names, but we are cross-nominated.
Okay.
However, for maybe buying a house, potentially when we know we're going to live in a house for next 10 years, we do our investments through a joint account.
You haven't bought a
Not yet.
What is the thinking? Look, I'm curious, because this is a conversation I often have, buy versus rent, right? And you've clearly decided, you're in Bengaluru, and you've decided to not buy a house. I've heard that it's more affordable than Mumbai. But why have you not bought?
So there are 2-3 reasons for that. One, which is more of a financial reason, that's about rental yield. Today in India, the best rental yield which you have in a house is around 3% or so.
Yeah.
So imagine I'm getting a house which is of 3 crores, but I'm paying a rent which is 9 lakhs in a year. So I can use that house for 3 years, 4 years. I can move on to the next house. I can keep shifting to better quality construction and better neighborhood with each enhancement in my income. So that is rule number one. Second, we don't want to be in a situation where we are continuously in stress about our EMIs. Now, 5 years from now, it could be possible that your job is at risk because of AI, my job is at risk because of AI. And I don't want a situation there when I have to worry about my working life only because I have to pay EMIs. That is rule number 2. Third is, when we buy a house, we have invariably seen that rationality of decisions take a backseat. What I mean to say is, let's say you have a house which is at place A. You want to put your daughter to a school which is at a distance of 10 kilometers.
Sure.
You will say, okay, let me not send her to that school. Let me send her to a neighborhood school. That is also okay. You start reasoning out, saying that that is also okay, which in actual may not be okay for her, depending on her profile and everything. You get a good job offer, which is 10-15 kilometers away from your home. Your spouse gets a job offer, which is away. And you say, no, let me not go there because my house is here. So the house becomes a center of decision making rather than an analytical approach for deciding which job to take, which school to send. And that's the reason we don't have a house.
But the counter argument to that is the stability and the security that it provides, which a lot of people gravitate towards. The reason, ultimately, that's the reason why you say roti, kapda, makan. And you don't have one of those 3 fundamental requirements when you are renting, because who knows what's going to happen with your income down the line. If you don't have a job, but you have a home, you have that security. That's the argument. How do you counter that?
So one is being financially secure. So we don't have a house, it doesn't mean we don't save. So which means I have a portfolio which is there. Tomorrow, if both of us have no income, the returns of the portfolio on an annualized basis is good enough to take care of our rentals for life. That is point number 1. Second point is, when you mentioned that one should have roti, kapda or makan, that is when you have stability in life. If we know for a fact that we are going to be in this neighborhood for next 10, 15, 20 years, for stability, maybe we can buy a house. But when our jobs are uncertain, when our location is uncertain, when we don't know where we're going to shift after 1 year or 2 years or 3 years, then it's better not to have that makan now. We can always postpone it. Maybe in 10 years from now, we will have a house, so, but not now.
Not now. Okay, so the thinking is very clear. We were talking about how you invest, and you said that you invest separately, but you're cross-nominated. Do you have differences in the way that you approach your investment portfolio? In that, do you have different risk appetites and approaches?
No, Alex, not really. While we do investments in our name, but when we look at the portfolio, we look at it at an aggregate level.
Okay.
Right? And no, the risk profiles are not different the way we approach it. It's just done in different names. However, we kind of for our discretionary expenses, which could be for, what I call the lifestyle expenses like travel, jewelry, home upgradation, we kind of tend to keep those funds separately as to how we plan to.
How do you do that? That's the question.
Right. So if I just take a step back, the way, you mentioned, do we take salaries? Yes, we do take salaries. And our long-term equity portfolio, gets built through SIPs, which we kind of, draw from our salaries.
Yeah.
From the bonuses, there are certain rule book that we have followed. So first, we ensure that the health insurance and term insurance is taken care of, not just for us and our daughter, but also for extended family where we may have a liability.
Sure.
So that, if, God forbid, at any point in time we need to take care of them, we are covered, right? Then we ensure that we have, if you look at a drawer or a wardrobe, put it into 3 drawers, right? One is essentials, which covers your advance tax, school fees, rent, etc. Second is what you call for your growth and development. So, we believe let money do the job. We don't look at our portfolios daily, rather maybe just once a year. And that includes stuff like grooming, learning and development, our daughter's interest, putting her in different hobby classes, etc. And third is what we call the lifestyle expenses, which
Your
includes
personal
travel, any luxury spends that we'd like to do, jewelry, gadgets, etc. So what we calculate whatever we may require for this on a yearly basis and park it into arbitrage funds. Remaining, we always keep some amount in the contingency funds because, fortunately or unfortunately, we are in the same profession,
so
which
there's
is
a risk.
Very subject to market risk. So we always want to kind of ensure that, it's like a spare tire, which we hopefully don't have to use, but it exists in the car. And then the remaining, which is we draw from the bonus, just goes into long-term equity, which we don't intend to touch for next 10 years.
Okay.
That is how we construct our portfolio.
So, guys, way into what I do, right? And it's pretty uncomplicated. I've been told that you shouldn't have investments that are a collective, right? But my wife and I, we invest together. We've got a common investment account and we've got our own savings accounts. We put a certain percentage at the start of every month as soon as we get our salary, and all of the SIPs go from that investment account, right? And whatever is left is for me to spend on whatever I want. And there's a substantial amount that goes towards a long-term saving.
Right.
That just seems to me very, very easy to do. Is there anything wrong with that?
No, that's exactly what we follow, Alex, as well.
So it's similar, but you've got a more structured way that you're doing it.
So, we believe, it is so simple, but we unnecessarily complicate it so many times. The simple mantra that you said, we earn an X amount, we save a certain amount, and the rest of it is guilt-free spending.
Yeah.
So, it is like sometimes, people eat first and then diet later. We pack a healthy tiffin first and then eat guilt-free. It's as simple as that.
It's as simple as that. Yeah. Okay. So let's get into how you're saving for your daughter, because you said that you've thought about this for a long time. When you initially drew up your plans, which is significantly before she was even conceived, what was the thinking like? What did you bear in mind? Did you plan, for example, that you would account for the most expensive education that you could potentially give her, which is something abroad? Or were you more pragmatic to say that this is what we can afford and this is what we're going to save towards? And what is the trade-off between saving for your daughter, which is incredibly important, and also saving for yourself? Because you have your own goals. Maybe it is buying a house, maybe it is your retirement, and maybe you want to retire at 45 or 50. How do you trade those off?
So first question which comes to any parent's mind is, or when we became parent, before that also, should we invest in our name or should we invest in our child's name?
Yes.
And there are pros and cons for that. And we meet a lot of investors and we always discuss the same question with them. Investing in your name and saying that money is fungible, some of it would be required for my son's or daughter's education, that doesn't work with us. And I'll tell you the reason for that. One, if there is an idea which looks very tempting, like buying a house, buying a luxury car or something, you may dip into your portfolio and say that I'll build rest of the portfolio at some other point of time.
Yeah.
So that is a risk. If you're putting money in your daughter's name or son's name, whatever may be the pressure or temptation, you will never touch that.
Sure.
You may touch it, but it would be 1 in 100 kind of a scenario. So we thought that let's have money in her name and not in our name. Now coming to your question on what kind of an education. So we thought that let's try for the best. Education which is outside India. It has two implications. One is education inflation in those countries. Second is currency depreciation.
Dollar,
so we have to factor in both.
Yeah.
So when we started investing for her, we decided we will invest in dollarized assets as well. So 25% of her portfolio is in gold, silver, and offshore equity, primarily US equity. So tomorrow, when she grows up after 18, 19 years, if US market does well, gold does well, silver does well, she will have money through that. If Indian market does well, she will have money here. And both at a blended level, if they generate 12, 13% return, we are happy about it. So that's how the structure was created. Ideally, yes, all the parents would want the best education. We decided what we could afford. We put in that amount of money. And in between, on her birthdays, instead of giving her gifts which are more product-based gift or material gift, we give her money. And that money also keeps on getting invested every year on her birthday.
Yeah, that sounds incredible. But this is a little girl that will still want her.
No, we do give her enough gifts. But, as a practice, we also park in some funds every year because the entire lump sum, Alex, whatever she would need is already taken care of. This is just a buffer. In addition to that, because, it's a girl child, we also, kind of started doing Sukanya Samriddhi for her, ever since she was born. I also do a PPF in her name. And, another thing which is important for your viewers to know is that, sometimes they forget to add the child to the health insurance plan. So most health insurance plans typically allow the child to be added after 90 days. So that's something they should be mindful of.
But they can't have an insurance policy for themselves, right? They need to be add-ons always.
Yes.
Right? Till what age?
18, I guess.
Right? You need to be an adult to claim it. And what about equity investments overseas? Because the mutual fund route is pretty much closed. There's Gift City, of course, but even that is not many options right now. And you can have a brokerage account or an trading account where you can invest in foreign ETFs or shares. How do you do it for your daughter?
So first, I would want to answer why global equity is important.
Sure.
In single sentence, India is 3 to 4% of the entire world's equity market capitalization, which means if we have to participate in 96% of the remaining world, we have to buy equity outside India.
Right.
Second, innovation, what is happening, especially in countries like US, is significant. And people generally talk about technology, but there is innovation happening in pharmaceuticals also. There is innovation happening in certain other domains like banking products and all those things also. So we feel there is a need to have assets outside India. Now, a lot of fund houses where we started SIP in offshore equity, they are still continuing. They have not stopped existing SIPs. So that is one. And second, there are 5 to 6 fund houses in India where they have funds where they still have limit to accept it.
Sure.
And we feel if the mindset is there to invest in overseas equities, maybe in a year, 2 years, 3 years time, the limits would open up for Indian investors also. And lastly, we have recently done Gift City also. So there are retail products in Gift City which are now available. Minimum ticket is $5,000. And we started participating in that because we feel it's extremely important to participate in equities outside India as well.
But do you keep within the 10 lakh threshold? I'm purely asking
for TCS purposes,
because of
yes.
the 20% tax collected at source that comes through.
Only for that reason, but ideally I would like to build her portfolio, on the Gift City side.
So what about the rest of the 75%? So how does that work?
Yeah, so Alex, that is one key reason why we, at least chose to do the investments in her name because, because of our profession, our risk profiles, sometimes are more nuanced towards the hybrid style, right? But for her, there was no purpose of having hybrid category funds because she's going to be there for 18 years, right? So yes, her portfolio is more focused on the flexi, mid and small cap heavy portfolios, funds. And because of the difference in risk profiles, we thought it was important to maintain it separately. On the large cap, I have opted for an index route for her because in 18 years, you don't know what is going to happen. So, and large caps, I think, are a fair play through index. But in mid and small caps, we have chosen, active funds. We also typically do not recommend closed-ended funds, but for her, I did opt for, one of the children's solutions from a leading fund house because we felt that, given the time that she has, taking more concentrated bets could be useful for her.
So a question, and this is purely out of interest, right? What I've noticed is the solution-ended schemes that mutual funds provide tend to be a little costlier than the other schemes that might have similar portfolios. So why would you want to do that?
So the reason I opted for that was, they of course come with lock-in products, and that's the reason we do not recommend it to, most investors. But since it was a newer fund, the possibility for the fund manager to kind of go for the under-researched stocks on the small cap side was a little higher. And that is a small portion of her portfolio. And I trust the fund manager. That is the reason probably I would have done it.
Fair. When you say you've opted for index funds on the large side, and you've got mid and small, so you're pretty much diversified on that front as well. But when you look at your active selections for her, you might have had the bandwidth to go a little more aggressive than you would ordinarily. Or is it similar to the selections that you've made on the equity side for your own portfolios?
No, so the profile is different. So what we have done...
What was the thinking is what I'm trying to get at.
Like Megha was mentioning that there is no hybrid fund in her portfolio. In our
Pure equity.
Pure equity. In our personal portfolio, we have a larger allocation to large cap, flexi cap. In her case, it's small and mid cap, which are quite heavily allocated in comparison to us. So the money which we have in our portfolio is primarily for our retirement. The money which she has, it's practically for her education, and she has a longer runway. We may have that kind of a runway, but the world is changing so fast, we're not sure about it. And one more thing I want to add here, which you haven't asked us till now. Who amongst us decide the family level allocation?
I wanted to ask that. I'm glad you brought that up.
So you asked us a question about the profiling.
Yeah.
Now I would want to draw a very important inference here. So the problem is men are generally speculative in nature. Women are not. And what we see among...
That's not a generalization, it's something you've seen as well?
Yes, I've seen that as well. There is a tendency to try every new thing which comes to the market. Crypto is in trend.
She's not coughing just because she doesn't agree with you.
There's no signal from her. So men generally want to do speculative assets. Like, you know, you would want to go on Kalshi, you would want to go on, you know, crypto platforms. You would want to try those things because there is a need for excitement along with making returns for men. While for women, it's more about stability of returns. So you asked about our profiling. Initially, there was a difference in profiling. In my personal portfolio, before I got married, the split was 50% in direct stocks and 50% in mutual fund.
Right.
Now it is 95% in mutual fund, SGBs, ETF, REITs, because I realized, A, I was wasting time of, which is important for my clients to be given by doing my own stock research, which was not required. B, sometimes you compromise on the risk management aspect of it. You feel this stock is good, you go overboard on that, and you may not get the desired
Sentiment,
returns.
emotion comes into
Correct.
play.
And we realize that moderate returns over a above moderate time period or a longer time period is much better way of making money rather than trying to have a fluctuating portfolio.
So Megha makes the portfolio?
So Megha makes the portfolio, and now our profile is in sync because I have seen the merit of spending time on my health, on my clients, on my hobbies, rather than just watching the screen entire day.
Oh, so guys, that's advice for you. You might want to consider speaking to your partner and figuring out what she thinks about the portfolio that you've constructed. Possibly you're taking on too much risk. But I do want to ask you this, right? Did you all at any point speak about when you want to hang up the boots, stop working? Because this is something a lot of people who are in our rough age group think about.
Alex, no, I think, you know, we truly, truly love what we do. We're very passionate about it. Maybe we would just want to work with lower number of clients, you know, after a certain age. But I don't think retirement is something I can live happily with. And I see that with my clients as well. You know, people who have opted for an early retirement, they start finding a vacuum. It looks very fancy, you know, sometimes given the high stress environments. But it is difficult to just do nothing once you've been into a full-fledged, high-demanding career. You know, it is tough.
And therefore, last question. When you think about life beyond a certain point, a lot of people think about investing in their child and thinking that their child will then return to them. What do you think about that?
I don't think child is your retirement portfolio.
That's a very straightforward, simple answer. You agree?
I agree, and I would want to add, health is your retirement portfolio. Focus more on that. I mean, there is no harm in paying extra to the trainer in the gym, going for that yoga class, which is expensive, spending on food, which is good for your health, but it's a little expensive. That's totally acceptable. What we don't do, we have a set of rules which we abide by. Both of us will never do. If I have 1 minute, I'll tell those. We don't invest in futures and options. We don't do any leverage. We don't have our house because we didn't want to leverage. And once we have a comfortable portfolio, maybe we'll look at that. And we don't invest in ideas which are given to us by others without researching. Like I was mentioning about cryptos and also, we don't have any allocation to, like I mentioned earlier, crypto, about ULIPs, endowment plans, any of these ideas, we don't have any allocation.
I love it. You've successfully made me hungry and want to go to the gym at the same time, and I congratulate you on that. But it's been a fascinating conversation. Thank you so much for taking the time.
Thank you, Alex.
Thank you, Alex.
Always a
Thanks for
pleasure
time.
talking to you.
That brings us to the end of this edition of Moneywise. Let us know what you think and whether you have any ideas that you'd like us to consider with regard to the conversations we take up on this show or any other. Thanks so much for tuning in. This is NDTV Profit.